Hi everybody, Elizabeth here with a quick reminder to visit fpfeaz.org to subscribe to Scott's full 2024 live Zoom class calendar. You can also visit yourinvestmentcounselor.com and book a meeting directly with Scott Sandell. Thanks so much for watching. Now back to the video.
Hey everybody, I wanted to talk about bond allocations because it's getting harder and harder to allocate portfolios to bonds or any part of them for that matter. So let's talk about this. Let's start with the basics of bonds. When interest rates go up, the value of a bond goes down. We have to understand that. It's always been that way. It's economics. If you own an investment that pays you 3% guaranteed for 30 years, okay? And interest rates for everybody else go up to 6%, and you're sitting here earning 3%, and you try to sell your investment, nobody wants to buy it from you. So you have to discount the price because they can just go to the open market and get 6%. Why would I want your 3% 30-year bond if I can just go get 6% elsewhere? So that's why as interest rates go up, the value of bonds goes down. It's that teeter-totter effect. Okay, well, in vice versa, it also happens. So if interest rates go down like they have been for 30 years until the pandemic, we hit zero, and that was the bottom. So interest rates kept going down and down from 1982-ish. We hit the peak of interest rates to 2020. 1982 to 2020, it's 38 years, we saw interest rates consistently going down and down and down and down in the United States. So that means the value of your portfolio, your bond portfolios, kept going up and up and up as you were getting paid interest. And that's wonderful. That's why bonds became the benchmark of all safe investing. Okay. But if interest rates go down and down and down and hit zero, then the bond values are the highest they will ever be. And the whole concept of investing is buy low, sell high. Well, if you know that an investment is the highest value it will ever be, why would you continue owning it? That's what we have to question ourselves. Okay, so when this relates to bond mutual funds or ETFs, bond funds, a portfolio of bonds represented by one price, the interest rate changes have immediate effect to the pricing. So if you bought a bond fund today and interest rates went up, then the value of that bond fund would go down. The price of that bond fund goes down. Whereas if interest rates go down, the price of that bond fund goes up. So we invest in a bond fund to get yield, to get paid interest. Typically, we're not doing it for speculative growth reasons. So 20-year plus of low interest rates means the portfolios that are inside these bond funds, the investments within the bond funds, they're filled with these low interest rates from the last 20 years. Remember 9/11? Yeah, we've pushed interest rates down to that 3% range, and we've been floundering around there for almost 2 decades, well, over 2 decades now. Okay, so we have bond fund portfolios that are filled with these old bonds that aren't paying much. And the only way they're going to make any quick adjustments is junk bonds. Let's buy a bunch of junk bonds. Woohoo, yay, great idea, right? Well, not if we want risk in our portfolio or don't want risk in our portfolio. So when we look at bond funds, this is going to be speculative going forward, looking to time rate changes, meaning buy now, hope interest rates go down, sell when they go down. But you got to remember the sell when they go down. We can choose to hold on to those bond funds, but we've got to sell when they go down this time. Then there's individual bonds. Price effect only if sold, meaning if you don't need your money, then this up and down in value doesn't mean anything. You're going to wait till maturity and get your money back. So if you're buying individual bonds, you should only be looking at the yield to maturity, or you should be questioning, are there call dates in the future and what your yield to call is? Because if they're paying 6% and interest rates go down, they're going to call it. They're going to refinance into the lower interest rates, right? So we got to be careful about those calls. Nobody calls their bonds if interest rates are rising. Everybody calls their bonds when interest rates are lowering. So be careful about that. And then alternatives may be better. So individual bonds, they've fallen a bit behind. There's other choices paying just as much interest with no risk. So why would we be looking at the corporate bonds as opposed to maybe some treasuries or other choices that are out there? So we have to understand interest rates, right? I just want to make sure people understand that over the last couple of months, we've had a drop of about a full percent in our interest rates. And that comes to us as a shock to a lot of people. What, really? What? Well, if you go back and look at your bond funds, vast majority of bond funds had a nice little boost to their pricing, right? We were at almost 5% on the 10-year treasury, and we dipped down to just below 4%. Okay. And now we've edged back up just barely over 4%. So we lost a full percent on interest rates, and most people didn't even notice it. Well, that gave you that opportunity. We had this pullback in interest rates because the feds came out and said, hey, I think we might hold off on interest rates changes, and it's very possible that in 2024 we might lower some of these interest rates. And immediately the market reacted, and then usually it bounces coming back to reality. So the feds haven't lowered interest rates, but boy, the market went ahead and made that adjustment in preparation for the lowering of interest rates. And that's what we have seen. So there's been a bit of an opportunity for bondholders, bond fund holders, to get a little bit of their money back and get that opportunity to get out of these bonds now that you finally realize that, oh yeah, bonds do have risk. Okay, but let's keep this into perspective. The pandemic had us almost at zero interest rates, and we're at 4% right now. In the grand scheme of things, that's nothing. We started this run down back in 1983 when interest rates were, 15% on the 10-year. So let's be careful about our perspective. We are still very low in interest rates. And if we see inflation again, if maybe oil prices start jumping again, and that causes other things to be more costly, and we see inflation numbers again, the feds are not going to be scared to raise those interest rates. Okay, anytime in our history we've seen inflation, that is what they do. We can argue whether that's right or wrong, but the reality is that's what they do, and that's what matters. Okay, so if we see another bout of inflation, they're not going to be shy. They're pushing those interest rates up, and you will lose value in those bonds. And if you're in the retirement years, you don't want that. If you're in your younger wealth building years, then you can wait through it. No big deal, right? So let's look at these interest rates. Now, I put the date on here because I don't know when you're watching this. I need to make sure you understand this is a snapshot in time. But if interest rates go up from here, then all of these interest rates go up. If interest rates go down from here, then all of these interest rates go down from here. This is to help you understand what's going on out there. And I've done some abbreviating of this, but you've got treasuries, 1 years at 4.8, 30 years at 4.2. We're inverted. We're inverted in our interest rates. You can get paid more on the shorter term than you can on the longer term, and that is bizarro land. That's not the way things are supposed to work. Every time we've inverted, it's resulted in bad things. Now, maybe bad things are coming. We don't know. It doesn't mean that it happens every time in the future. It means it has happened every time in the past. Then you've got the corporate bonds. I just did the A and AAA. Double A is somewhere in between these rates, but you can see fairly flat interest rates. The shorter term, you're getting paid 5, 4.7 in there. The longer term, you're getting paid 5, 5.8-ish right in there. So that's what you're going to look at in terms of yield to maturities. This is what you should expect. You might buy a bond that's yielding 2%. But actually have a profit, a yield to maturity of 4.7. So just understand, this is your total profit you should expect if you were to buy a bond and make the calculation of yield to maturity. Municipal bonds, you're going to see slightly lower interest rates. Notice that you got a full percent less in some cases here. So the reason for that is, well, they're tax-free, and that's an incentive to pay a lower interest rate. That is very normal. That's the way this works. And then CDs, just for reference, the CDs, really their strong point is the short term 1 year. You can see the best choice for a 1 year right now is go to the bank and get a CD. Whereas you get to 5 years and then you've got some alternatives. So the CDs are pretty worthless if you go beyond there. There's better choices. Well, what about these money market funds? Everybody's asking me, oh, these money market funds are great. Yeah, they are, they look fine, but they're guaranteeing it. Oh, by the way, they only measure it on a 7-day yield, the SEC 7-day yield. Oh, that's because they can change the interest rate tomorrow on you. And if interest rates go to zero, these will be at zero. So they look good, they feel good right here and right now, and that's what they're paying. You look at all the money market funds that are out there, the Schwab's, Fidelity's, Vanguard's, T. Rowe, Invesco, they're all little over 5%. They're all virtually the same. All right. So that's what you can expect to see out there in terms of money market funds, but they can change the interest rate in a moment's notice. Then there's the bond funds, mutual funds. So I went and grabbed all the biggest bond mutual funds out there. There's your tickers. Typically BND is the first one people go to. BND is the most popular out there, and the yield is 4.31. And I can tell you that I was actually shocked it was that high. And I assure you, if I go in there and start looking at it, they are buying much lower quality bonds to get that yield up. Right? They've had 20 years of filling that bond fund with investments of lower interest rates. And for the last couple of decades, you were getting paid 2-3% yield. And now you're getting paid 4.31. Well, 4.31 is still way behind the rest of the world here. You can get paid much more than that everywhere else. So the only reason you want to own a bond fund is because you think that interest rates are going to go down, therefore making it more of a speculative investment. On the safer side of speculative investment, but you're not going to be happy if we see inflation and the Feds jump interest rates again. Okay, so you look at these yields, the only reason they're achieving these is because they're lowering their parameters on the risk in there, meaning they're putting in the triple-B bonds. They're filling this thing, especially a bond fund like BND. They, a lot of these are going to specialize in the AA, AAA type investing, safer bond portfolios, but you're going to start seeing the triple Bs in there real quick to get more yield. And then what do we got next? Well, we've got the MYGAs, and I'm just reviewing the fixed interest rates out there. There's plenty of other choices, but MYGAs are simply CDs from insurance companies, multi-year guarantee, the dirty word, annuity. But these are just CDs from insurance companies, a fixed interest rate for a fixed period of time. And if you set these side by side to any of these choices here, I would take these MYGAs right now before I would take a bond fund, before I would take a money market, and certainly before I would own any individual bonds. Because when I look at this, I say, okay, well, here's the 10-year, the best 10-year, let's see, a single corporate A-rated bond, 5.3%. 10-year, I can get paid 6%. This, I have risk of default, which is low risk of default when you're in the A range. Okay, I get it. Let's throw that one out. Risk of calling it due and not paying me my interest. Oh, that's a problem. I locked that in because I wanted to get that interest, right? Okay, so that's a problem. Fees. Just so you know, there's going to be fees in this somehow. If you're buying it from a broker on your own, you're paying commissions and you're not even told you're paying commissions. Trust me, they bought it at this price and sold it to you at this price. That's how that works. So there's lots of issues on that side, but then the raising of interest rates or lowering of interest rates is either a risk or an opportunity as well when it comes to selling it. If you need the money, you got to sell it, and you're exposed to that market risk at that point. Whereas the MYGAs, the multi-year guarantee annuity, I'm locked in at 6%. Interest rates can go up or down. There's no market value. There's no issue. It is just like a CD. It is there, guaranteeing 6% interest, compound daily, by the way. And if I need money, most of these give you access to 10% of the money. So as long as you don't need more than 10% of the money in a year and each year thereafter, then this has no risk and no fees, by the way. So looking at these interest rates, understanding that you can actually use this money and pull it out if needed, and the interest rate is locked for whatever period of time you choose to lock it in. Right now, snapshot in history, and by the way, it's been this way for quite a while, these MYGAs are the best fixed rate safe investment out there. Okay. So how and where and when do we use each of these safe investments that I just went through here? Okay. So individual bonds, I have no problem recommending it as part of an income portfolio. You're trying to create yield. You want to get maybe some MYGAs, you want to get some bonds, you want to, spread it out, some dividends, get a lot of different things and put a well-diversified income portfolio. That's for people that don't need the principal. This is just their fun money. Markets can go up and down, up and down. As long as I'm getting my yield, I'm getting that, I should be fine. I got plenty of a backup. I got a cushion for emergencies if I need to, maybe buy a car or something. But the portfolio's producing an income for me, and I don't really anticipate needing any of the principal of that part of the portfolio. Then I don't have a problem buying individual bonds. We've got backups. I don't need to sell those halfway through until maturity. We can hold them till maturity. There's nothing wrong with individual bonds in that case. Bond funds. Owning a bond mutual fund or owning an ETF. Well, I got to be honest. The only reason I could come up with, and I talked to a few other of my cohorts, because I just had a hard time thinking, am I going to recommend buying a bond fund right now? And the answer is not really. No, unless we're looking at more as a stock allocation, meaning we're looking at it because we think the future is brighter in that bond fund, meaning we think interest rates are going to come down. And in that case, is this a blanket safe investment? No, we're looking at a bond fund as an opportunity investment, not as a blanket safe investment. So bond mutual fund takes on a different look. It's about market timing, but market timing is a little easier when we talk about interest rates versus market timing of the stock market. So I would say it's more of a low risk market timing type investment. Okay. Then we got CDs. Who would I recommend using a CD? Well, the core competence of a CD is, hey, I'm going to need this money a year from now or 2 years from now. So I'm going to go buy a 1-year CD. I had somebody that sold their house and was going to take a year off, had committed to taking a year off, but then they were going to decide a year from now when and where to buy. And so 1-year CD made sense. It was the highest interest rate for 1 year that they could find out there. Okay, so nothing wrong with a CD if we have a plan for this money, but as a general investing idea, oh, just a 1-year CD, and then I just plan on using another 1-year CD and then another 1-year. No, it's a terrible idea. Interest rates are way higher than they have been in 20 years. Why would you keep using these lower interest or these shorter term interest rates when general idea is that interest rates are going to be lower in the future? The Feds have already hinted towards that. Most general thinking out there believes interest rates are going to be lower in the mid to near future. So locking into shorter term interest rates doesn't sound like a good idea, because if interest rates are lower, then what are you going to invest in? Well, you're going to get paid less. So when we have a spike of interest rates, you want to lock them in for longer periods of time. If you need your money, if this is money you're stocking away to buy a house, and money you're stocking away to buy a car, money you're stocking away for a predetermined period of time, great, go buy your CDs. Money market accounts, kind of similar, right? If you know you're imminently using the money. So for instance, there are people that I come up with plans for quite often that don't have any income. They're in that middle period where they retired, but they don't have Social Security or pension income. So they're relying on their portfolio to fund their entire retirement bill right now. Okay, this is temporary until they get to Social Security, but that means they have a greater need for their savings going into their bank account on a regular basis. So we figure out, okay, well, we need 1 year's worth of savings plus a cushion. So maybe somebody needs 100,000, 150,000, 200,000 for their immediate needs within a year. And the idea with that is then put that larger amount of money into a money market account and feed yourself a paycheck from there. So that way that money market account is paying you that 4 or 5% interest, and you're getting it into your bank account and you're able to pay your bills. And if you have an emergency, you just reach in and take some more of that out. And then every year you refill that money market account. So this is for the money that we are eminently using, and we're just trying to be more efficient with it. Treasuries. Would I recommend use treasuries? Well, treasuries, look, they're cumbersome. They're not easy to utilize. You know, you don't just run and manage your whole portfolio in treasuries, especially when it comes time to actually functionally using your money and spending it and taking money out and withdrawing it. It's really not fun to manage your money at treasurydirect.gov. And the reality is this is more those ultra conservative people. Instead of CDs and money market accounts and bond funds, they want to look at stuff like that. Well, look, the perfect world, you want to top tick interest rates. And honestly, I don't know that I would buy a 30-year investment. But if I was confident it was the highest interest rates I thought we would see, sure, you want to lock those in longer. 30 years, boy, it's really hard to predict 30 years from now what things will look like, much less, a year. And that's why people mentally keep looking at these CDs and money markets. We tend to live in the here and now, and that gets us in trouble, right? So if you could go back to 1982 and lock in a 30-year treasury, you made the smartest move you could ever have made. 15% for 30 years, think about that. That'd be wonderful. So, well, treasuries, this is for conservative people. They've got some tools, inflation protected securities, things like that. Okay, little bits here and there, no big deal. But allocating a bigger part of your portfolio, you have to be super conservative for that to be your safe investment, because historically and currently, treasuries fall behind your other choices with limited to no risk. And then MYGAs, multi-year guarantee annuities, the CDs from the insurance companies. Again, there's other choices, there's variations of MYGAs, but those basic CDs from insurance companies, right now, you put them all side by side to these other choices as an investing choice for people heading towards retirement or in retirement. These are the ones that win right now. They have higher interest rates than all these other choices. So you're able to lock in these higher interest rates right now. Back when things are 2-3%, maybe you wanted to keep doing 1-year CDs, even though when interest rates were 2 or 3%, CDs were paying 1 or 2%. That's the problem. You just don't want to do it. But I can understand if interest rates are rising, you just want to do shorter term stuff. If interest rates are peaking, you want to do longer term stuff. If interest rates are lowering, you want to hurry up and grab what you can. Functionally, these are better than your other choices because you have access to the money. The treasuries are cumbersome, have rules on when you can sell. You're going to be market priced on a lot of these, so you do have that market risk of interest rates going up and down. Same thing with individual bonds, same thing with bond funds. CDs, you're locked in or you pay the penalty. And money market accounts, you have 100% access, but they can change the interest rate in a moment's notice. So MYGAs give you something in between here. They give you those locked in higher interest rates, and they give you a functional access that allows you to take money out along the way and use it. And I think that's what a lot of people miss about these. There's no need to sell at market pricing. There's no need to pay the penalties. You can just simply take money out. You can have it transferred right into your bank account. Okay, and knowing that this is compound and tax deferred, functionally we can take money out, but if we don't need to, if we're in that early, maybe within 5 years of retirement and we know our money is going to sit there and grow, but we want safe investments, most of you people are in bond funds, and I would rather be in something like a MYGA because it fixes that interest rate and it compounds daily. So if you think about that, this is a better buy and hold than bond or bond funds. This is also a better buy and use, take the money out and spend than those CDs or bonds as well. So right now, just Looking at the landscape of all these fixed rate choices, these do win in most cases, but there are reasons to use these other choices. So when do I use bonds? Well, I can see scenarios where I recommend them. I'm actually building a bond portfolio right now. There are some reasons. One more individual bond reason. If you've got a pile of after-tax money, not IRA, not Roth, you can get municipal bonds. They pay less interest, but they're tax-free. So maybe some people are in unique circumstances. I've met people that had very little to no IRA and Roth money and had all after-tax savings, still wanted safe investments. Well, all the rest of these pay interest that is taxed at full tax rates, whereas a municipal bond is going to give us that diversification into little to no taxation. So there are little opportunities here and there that bonds might make some sense, but I would look at bond funds more in the kind of more safer speculative world. It's not the blanket safe investment, but it's a way to maybe market time and opportunity that's a little easier to predict than maybe the stock, trying to time stock market. All right, I hope that helps. That gives you some perspective on how to utilize bonds in your portfolios. Certainly, I'm happy to help in any way. We just launched our website, yourinvestmentcounselor.com. If you want to meet with me for any reason, it's up to you how you want to deal with that and meet with me. I truly believe that I can help in a lot of different ways, and I'm not here to just take over management of your money. So if you just need some hourly advice here and there, I'm always happy to help with that stuff. And that's really the big reason for the launch of this website. And it's working out wonderful. Happy to help for any questions. Give us a call, shoot us an email, jump on the website. And if you're looking for our full form classes, hour-long type classes, we're doing them over Zoom nationwide now. Visit our nonprofit website, fpfeaz.org, and you will find the full class schedule right there as well. Thank you. Like, share, subscribe, do all those fun things, and we will see you next week.